it's going to be very volatile. And as we see that volatility play out, I think investors are going to have to take advantage of those big movements.
This is Kaiser Johnson with Liberty and Finance, and these are the Miles Franklin Weekly Specials for February 19th through February 26th, 2024, while supplies last. First, we feature 2023 1-ounce silver Britannia at $3.15 over spot with a minimum order of 50. We also have 1-ounce Gold Krugerrand at only $59 over spot. And finally, we're offering 1-ounce Platinum Valcambi Bars at just $69 over spot. To order our specials or any of the many other options we have available, call us at 1-888-81-LIBERTY. That's 1-888-815-4237. We're available after hours and on weekends, and we look forward to speaking with you.
Hey everyone, this is Elijah K. Johnson with Liberty and Finance. And back with us today is our good friend Tavi Costa from Crescat Capital. Thank you so much for joining us today, Tavi.
Thanks for having me. Looking forward to this.
Well, it's great to have you today. I did want to discuss one of the recent charts you put up on silver. You're showing really the cup and handle formation we're making, and you said you don't know exactly when it'll break out, but this is extremely bullish long-term for silver. Can you expand on that?
Yes, and I for those, I'm not a trader, but I do respect technical trends, and as a macro investor, I think you want to be early in those trends and accumulate assets before those breakouts. So those assets that are distressed become incredible opportunities as you see prices of the metals increase and change the economics of every project in the world. And so I think that that's really one of the things that really makes me so excited about silver. I mean, I've gold to silver ratio today, it's over 85, which historically, every time we've seen that, it actually coincided with periods when you want to be buying silver, not selling. There are some really outstanding opportunities out there with important projects that have been already operating mines with great silver production profiles that will offer even better economics as we see silver prices breaking out. So my focus right now has been solely in that front. And, I don't think this is the time. The fact that it hasn't happened yet, that breakout from that cup and handle, doesn't mean you should be discouraged and changing your focus. I think this is the time when you want to be extremely laser focused on this opportunity. And given the fact that we're all waiting for a moment where gold really breaks out more decisively, and as we see that happening, I think that that's going to drive not only attract capital into this industry, but really I believe silver is going to lead to the upside in a big way. And so, precious metals to me is the main focus. And so I really want to make sure we have a large exposure there.
Now that formation, the cup and handle formation, what type of price does it really forecast or predict for silver?
Well, cup and handle formations, usually you have a breakout from those prior highs. And so you would expect that, it wouldn't be surprising to see a triple digit number in silver prices. And so at the end of all this, but it's going to be very volatile. And as we see that volatility play out, I think investors are going to have to take advantage of those big movements. But you want to be buying these things before the big move, not after, when all the confirmations become very clear that we are in an upward trend. By that time, you're not going to find any distressed assets anymore. So distressed opportunities are distressed for a reason. And so that's really why you can find mines today trading at 2-3 times free cash flow at current metal prices, which is crazy. And so I think that's to me, it's more of a setup to take advantage of rather than run away from it. And it wouldn't surprise me to see triple digit numbers in silver prices as we see this cup and handle unfolding here.
And it is interesting to see how little investors are invested in the precious metal sector. If you look at gold, you recently created a chart here about 71% of investors have less than 1%, 0 to 1% invested in the gold sector. What does that say to where we're at in this bull market? Because it seems like we're far from any sort of top. It hasn't even really begun yet.
Well, we're in the process of seeing correlations change in markets where the 60-40 portfolios worked really well until recently. And then with the turbulence in the markets, that hasn't really been met with an appreciation of the treasury market, certainly brought a lot of attention. And it's been sort of, covered those issues by the fact that the equity markets have done so well. So if you own a 60-40, 60% of your portfolio actually did really well the last year or so, but that's probably going to change. And as we see treasuries becoming less and less of a good diversifier for those portfolios, I believe that gold is going to be entering the arena and starting to become a larger and larger percentage of those defensive allocations in portfolio construction. And so that's one side of it. And the other side of it would be central banks, because if we do the same calculation on central banks, they also own before, in the past used to be 70%, over 70% of their balance sheets used to be gold. And now it's less than 20%. So that has a lot of room for change. We know that central banks have been buying record amounts of the metal. But when you put it into a historical perspective, there's a lot of room for that to grow. And so, I like stories, or I like investment ideas that have that alternative and large percentage of ways to for your thesis to play out. And I can't think of a better one than precious metals, because you have the 60-40 portfolios being pressured to change their allocation. You have the central banks doing the same. You have the skepticism across, the globe really towards the metal. You have most people focus on crypto now, and crypto basically is NASDAQ, right? It's the same trade. I mean, if you look at Bitcoin and NASDAQ, is no difference, especially in the last 3 years. And so I think that that's all linked. And to me, it's a much better opportunity to be a buyer of metals here, because I think that price change will be very meaningful in terms of changing the multiples of businesses that have that leverage towards the gold and precious metals overall. And as we see that occurring, I think it's going to create a lot of a great generational wealth opportunities.
Now, as for the miners, you've talked about recently how they're really undervalued compared to the metal. Can you expand on that? And there's also a question a lot of people ask is, with rising energy prices, is that going to have a negative impact on miners? So your perspective on both of those ideas.
Look, I think there's a lot of things to unpack there. Number one, yes, miners are extremely undervalued right now. If you look at the GDX ETF, it's sort of not telling the true story, because royalty companies have kept their ground quite well relative to the miners overall. But if you look at miners like Newmont, they're down over 60% from their peak recently. And that's, reminiscent of other periods like the global financial crisis, in which it declined quite a similar number, actually, about 67% from peak to trough. And so if you look at the fundamentals, they haven't drastically changed in the last 2 years or so. Well, the big changes, if you see, is companies are still doing more and more shareholder-friendly policies, such as especially dividends. Now, some of the miners are now paying more dividends than the utility companies. Utilities, for those who don't know, is a proxy for treasuries. People buy those companies in order to receive yield. And knowing that a lot of those yielding instruments are actually lower than miners, which carry a lot of capital-intensive properties and other things, it is very telling of how conservative those companies have been in the mining space in order to attract investors to invest in their companies. But from a usual, argument regarding the miners is the fact that we're seeing production costs rising substantially. The problem with that analysis is that people immediately then link that to energy prices. and then link that back to gold, to oil. And if you looked at, now I saw somebody else commenting on one of my tweets regarding how, you want to be buying the miners when the gold to oil ratio is declining. And that sounds plausible, right? Unless you really understand the mining industry. And if you do understand it, you will see that energy costs, despite the fact that it's something significant, it's not all the main factor you should be focused on. In fact, the prior bull market we had in the mining space, which was the early 2000s, a sustainable bull market that we had, the gold to oil ratio was actually falling, not rising. And so, that to me is very telling, where yes, there are some projects and specific companies that are very linked to oil prices, but the overall industry is not. And you may see, I'm very bullish on oil. Does that make me bearish on the miners? No. In the 70s, you should have been buying both, with your portfolio. And so to me, this is sort of similar in that sense. And then not just the 70s, the 1940s, the 1910s, all those 3 decades, which are highly inflationary decades, you wanted to be buying hard assets and hard assets businesses. And so, which ones are those? Well, energy is one of them, and the miners is another one. And so, I think people are overthinking. Just because we've had a bull market in energy that wasn't really met by and accompanied by the mining space, it doesn't necessarily mean that the mining industry is in a terrible state or anything like that. And for those that talk about production costs, look at the relative performance of gold versus gold miners versus gold versus then look at the copper miners versus copper itself. And you're going to find that copper miners actually had a very good relative performance to their underlying metal compared to gold. And why is that? They both face the same thing in terms of production cost. And so, what I'm trying to say is it's nothing to do with the energy prices at all. It's been something more specific with the gold miners, given the fact that people have been completely neglecting that industry. Now, is that the end of the gold miners? Is that are we in a structural shift of the market? That's not my view. I think the gold miners are not only one of the oldest industries out there, but will probably be one of the most profitable investments in the next decade. And so I think it's time to be buying those neglected parts of the market rather than continuing to ignore them.
A lot of people are looking towards precious metals because they don't really see anywhere else to go. When it comes to, for example, the general equity market, you've talked about how it's extremely overvalued right now. You put together the market cap to GDP by country of a whole lot of different countries here, and showing that the US, the stock market is more overvalued compared to our country's GDP than pretty much any other nation out there right now. Did you want to expand on that?
Yes. Look, I think there are some incredible opportunities in South America. Some companies that are trading at a single digit multiples. If you get into a resource favorable environment, and those companies and those economies are abundant in terms of commodities. And so you would expect them to do very well in those setups. And I think we're likely going to be into another one of those. And so I like to be buying Brazilian equities in South America overall looks very attractive, relative especially to the US. If you can see that trade in very different ways. And one of the main reasons why we've had this discount of prices during across emerging markets relative to developed economies, and particularly US, has to do with a lot of things. It has to do with political risk, which won't change, by the way. We just likely to see markets prioritize other things instead of the political risk. No, I'm not expecting the political risk to change at all. That in the early 2000s, emerging markets are a great opportunity, although the political environment was crappy. It was terrible. Lula was the president of Brazil in the early 2000s, and guess what? Brazilian markets went up 18-fold. So there are times when the markets change what they prioritize. And I think that we're going to be entering another one of those. One of the things that it's in line with what really caused this underperformance recently, it has to do as well with what I think is the quality of labor markets. And recently we're seeing what I call this AI paradox, where a lot of people are thinking that big tech, big companies are going to be always benefiting from all this. I actually think that the fact that those AI tools are really true capability enablers, and in a way where it's allowing companies that used to have a whole team to work with, and now you're seeing some of those tools helping smaller companies with small amount of employees to basically have all sorts of incredible assistance for free. And that's a huge change in this in the labor markets, because if you extrapolate the same thesis into emerging markets and you start thinking, look, today I use ChatGPT all the time, and I basically have a geologist, a chemistry, a historian, all sorts of assistants working for me for free. It really isn't. I have a programmer, a mathematician. I mean, all those things. I mean, I can ask any question. And so, back in those days with emerging markets, didn't have that. So the gap of the quality of labor was massive. Now think about that actually closing, not completely, but closing significantly. And what does that do? Does that make those emerging market companies a lot more competitive? I think it does. And not only that, those multiples differentials between a business in Brazil versus in the US, I think they're going to be at least a lot smaller than what it is today, which is at historical levels. And so that's just my 2 cents on how this whole thing this dynamic will unfold.
No, when it comes to the stock market, are you seeing any fundamentals right now that would signal that we would be seeing a crash coming ahead? I know you put out a chart that really showed the correlation we're seeing between what happened right before the 1929 crash and what is happening right now in the S&P 500, and it doesn't spell good things for the stock market going forward. But on a fundamental level, are there any signals you're seeing that would signal that we're headed for a crash ahead?
Lots of them. And I would say that, that chart specifically referring to brought more trouble to me than good things because it speaks to the sentiment. I think a lot of people in the very beginning of that tweet, I believe I said, although these types of trends and analogs don't tend to work, I thought this was just an important historical perspective because we had such a strong rally in equity markets recently. And if you look back into 1929, before that big crash, we saw something very similar. And people tend to say, well, even the early 2000s, what happened was we had this concentration as well in markets where most of the mega cap companies are carrying the indices. And then, those things are starting to fall apart. And in March of 2000. And then later part of that year, what happened was Russell 2000 and the rest of the market began to actually catch up and go up. And so you're starting to see that broadening of the breadth of the market. Think about that. You're probably looking at it and you're saying, well, this is very bullish, right? Because, now you're seeing all these other industries that have lagged now actually starting to catch up to what technology did, 3 months, 4 months ago. And guess what? That was the very top of the market. So it's so important to look at those prior bubble territories to see how things really played out during those environments. And 1929 was another one, of course. So things are different. Gold was pegged at that time. So think about the monetary dilution policies we have today relative to those times. It's shockingly different. Now, there are some similarities that we should also pay attention to. The wealth gap problem is a great one. The concentration of mega caps is another very important one. The leverage is another important one in the system outside of the government is a very good one too. So, I don't necessarily pinpoint that's a time in history you should be watching for, but there are things that you should be at least aware of in case things are unfolding similarly today. Now, you asked me other things. I mean, the yield curve inversion from being deeply inverted and now de-inverting. Well, that's usually a sign of a recession ahead. The labor market's starting to show some issues. Yeah, that's also a sign of things that are probably about to turn. The fact that we're seeing all the small cap companies that represent well the economy completely having a very different performance relative to mega caps, that's also something very telling. So, I think that this the construction of the market is shifting in a large way, and it's scary, seeing the semiconductor businesses today in terms of the weight in the market, retesting periods like we saw back in the bubble of the early 2000s of the technology bubble. Those things are, they don't end well usually. And so I just don't know. I don't have the crystal ball when things are going to pop. But, would I be putting my capital today to, for the long term and closing my eyes to see where things are going to be 5-10 years from now? No way. I think there's better things to be putting their capital towards. And I think natural resource companies are going to be proven to be one of those segments of the markets that are likely to be doing very well.
Now, mentioning the yield curve inversion, we've talked about a few last times we had you on, the chart that you put up that is the percentage of yield curve inversions in the US, and how really when that gets above 70%, we see a recession or an economic crisis. And you've really put that all together very clearly. Now, we're actually at 15 months for when we've seen more than 70% of the yield curves inverted. So what is that signaling? Why have we gone so long with this yield curve inversion without some sort of crisis?
That's a really good question, and I wish I had the perfect answer for it. But I think it's been a lot of big differences in terms of the signals we're seeing in the treasury market versus other times in period. I don't think this time is different, by the way. But there are some differences that it's important to notice. One of them is the fact that the Fed is facing an inflation problem near term that it hasn't faced in a very long time. And so it didn't know how to deal with that. And therefore, it called it transitory. It tried to say all sorts of things to avoid, calling it a long-term issue. But at the end of the day, they had to raise interest rates to levels that we haven't seen in a very long time. But not only that, but really the speed of how they act was something that really caused the yield curve inversion issue. The second thing is that usually during other recessions that we've had, you tend to see the 10-year yield fall as the Fed starts raising rates because people start having expectations that we're going to see a recession ahead. And this time was not that way at all. Basically, what happened is very stagflationary, where 10-year yields are rising. But during the 70s, the stagflation was causing 10-year yields to rise and 30-year yields to rise because of the inflation issue. Now, today, I think inflation is also a problem. But the main issue as well is the number of issuances of treasuries that are happening in the market that are also causing the upper pressure on yields in the long end. And so, it's a little bit of a different dynamic in that front, but I still think that, the fact that we have seen 15 months, as you pointed out, consecutive months of this yield curve inversion problem, one way to play the recession idea and one way to play the end of that would be betting on a steepening of the yield curve. And then people start thinking, wow, but should I, do you think that that's because the 2-year yield is going to fall further, or the short term is going to fall further, or the long? It doesn't matter. If it's steepening, that's all that matters. And so to me, that's not an easy trade. There's no easy trades out there, but it's something that sounds very plausible, just given the fact that, first of all, we've seen such a long period of inversions, and also knowing that we this frothiness and people being so bullish, may actually cause a recession here soon, and a steepening of the yield curve actually be in line with that. So I think it's one way to play even the reemergence of inflation. I can't see the 10-year yield not outpacing the 2-year yield, because the Fed is trapped at the end of the day, and the Fed can't raise rates too much on the short end. So I would suspect that the long end would actually rise even further. So there's a lot of ways to play this steepening of the yield curve that really sounds very attractive to me. I mean, you always want to look for optionality when you have an idea, and I think this one has a lot of optionality to work.
And if our viewers are interested in learning more about your analysis, where can they find you?
You can find me at our website, crescat.net, or also they can find me on Twitter at Tavi Costa, and I share a lot of ideas there. But those are the places you can find me.
Fantastic. Well, thank you so much for your time, Tavi. Any last thoughts before I let you go?
No, just think that's too many problems on one side and too many great things to focus on the other side. And, I think a lot of people just like to look at the news rather than react towards it. And I'm always thinking about ways to express my views in the markets instead. And I think there's no shortage of ideas out there, regardless if it is, precious metals, if it is the private side versus the public side, if it is, creating a roll-up strategy to buy all these projects that are very cheap, or the energy side that looks really attractive. Agricultural commodities are also another place to be. In our view, emerging markets versus developed markets also look really, especially the ones that are resource abundant, that there are many of them. And so there's no shortage of things to be doing. Even in the small cap in the US relative to mega caps look attractive to me as well. So while there are a lot of risks, I think there's a lot of opportunities. And so I'm definitely looking for those right now to deploy capital.
Fantastic. Well, Tavi, thank you so much for your time, and God bless.
Thank you.
This is Kaiser Johnson with Liberty and Finance, and these are the Miles Franklin Weekly Specials for February 19th through February 26th, 2024, while supplies last. First, we feature 2023 1-ounce silver Britannia at $3.15 over spot with a minimum order of 50. We also have 1-ounce Gold Krugerrand at only $59 over spot. And finally, we're offering 1-ounce Platinum Valcambi bars at just $69 over spot. To order our specials or any of the many other options we have available, call us at 1-888-81-LIBERTY. That's 1-888-815-4237. We're available after hours and on weekends, and we look forward to speaking with you.